All right. Welcome back, everybody. It's been a while. I think 6 months or more since we did our last roundtable. Quite a bit's happened. I think our last one was even before the election. So thought we'd just recap some of the things that happened over the last 6 months, how the markets have moved, and maybe some of the things that they're in the news, people are talking about, our clients are talking about, and that we find relevant to to the markets and the economy. I'll let Cal start it off, but basically, we'll go through a little bit of market recap, but probably the summary is it's felt a lot like a nice average temperature with one hand in boiling water and one hand freezing water, and you say the average temperature is really nice, but I think most people would say that it's been a little bit of a bumpy ride, but maybe back to about even.
Yeah, thanks, Adam. I was joking. I had a couple client meetings over the last few months, obviously, and it was one of the things where it's like it's been a pretty quiet year so far. And most people react with a little shrug and a laugh, and that's the case. I mean, depending on when you're meeting and when you're talking with clients, it's always kind of the thing we talk about is timing is relevant. But it's if you're meeting in the middle of April, the downtime, the world's coming to end, the tariffs have been implemented and talked about, and markets were down. If you look at kind of the S&P and the Dow, they were down anywhere from 14 to 18% for the year. From the highs, and then the NASDAQ was down about 25%. And it was, okay, well, is the world coming to end conversations again? Fast forward, we put some pause on some of the tariffs and some negotiations come in, and all these indexes essentially recovered those losses that we saw in that couple-week period there. So Dow, S&P have recovered almost fully, and then the NASDAQ was down about 24.5%, and it's back up 24.5% from the lows. So year to date, it's kind of flat. So like you said, it's been kind of a wild ride to get back to even. And so Dow's up, or down just slightly for the year, about a quarter point. The S&P's, up about a half a point. NASDAQ's down a point. And we've seen some positive returns for the bonds so far for the first half of the year here, roughly about up almost 2% for the year. And commodities are down about 1%, a little more than 1%. So I know one of the things we've talked about too is kind of that volatility metric. And so from the high when things were looking really kind of questionable in April, I think the VIX hit up around 82 in April. And it was 82 or 52.
Yeah, but if you don't understand 52. The VIX, I mean, for most people, it's like, it's around 20, 25, 30 is considered, starting to consider getting volatile. So yeah, it was wild for a little bit.
It's just our volatility measure, right? Yeah. So it's the fear, the panic in the market, if you will. And so it's back down to around normal levels of that, 18, 19 right now. So it just kind of seems to be kind of stabilized a little bit here and pretty resilient.
Do you have the international number?
I don't have the international.
Plus 14 right now for the year.
I'll show you here.
We're flat in the U.S.
I'll give everyone a visual. So I've got a chart here called Markets Year to Date. And this is kind of a visual summary of what Kyle was just explaining. And so, if you went to bed on January 1st and woke up today, things look okay. But, we've fielded the phone calls, talked to clients, and everyone's been watching the news, and it's been anything but calm. And so my point of this visual, though, is, when we work as your financial advisor, I mean, really what we're honing in on is balance and diversification. And so as hard as we were blue in the face last year defending a balanced portfolio because everybody just wanted tech stocks. Yep. And the one thing that does well, usually everyone wants to chase. I mean, my eyes opened, I think it was like November, December, when I had a client for the last 20 years has only been in government bonds, and she's 81 years old, and she wanted me to explain to her what NVIDIA was and what these tech stocks were and what these companies were and things like that. And so you can see when things get hysteric. And so when we preached diversification, you're going to see the example here. And so, if you just watch the news and you see the red and the green and the red and the green and the big numbers and the headlines and headlines and headlines, and as we all understand, the media is there to drive fear, and they do a very good job with it. If you have a balanced portfolio, like many of our clients do, it was the U.S. stocks that were impacted, but everything else kind of hung its ground. International stocks were up better. Bonds were up. Some of the commodities like gold did well. And so if you've got a balanced portfolio, you might have seen on the news that the stock market was down 10 to 15%, but a balanced account was maybe down mid-single digits.
If that. Yeah.
If that.
And it's a lesson again of what role we're supposed to play. Are we supposed to, for most of our clients, the idea is to stay wealthy, right? Not get wealthy. We don't have a lot of people that come to us to figure out how to get rich.
Yeah.
It's hey, I want to hang on to what I've worked really hard for this. I want to hang on to it, and that's what diversification is all about anyway.
Yeah.
Yeah. International's lag for 15
years.
Yeah, 15 years. And then the gold, I mean, I see that gold chart up there and it just makes me think that, people are going to start calling soon. And should I be buying gold? It reminds me of back in 2011 when everybody was, hot on gold and then it drops off the face of the earth for, 6, 8, 10 years. And now it's back. But if you look at gold, I mean, before anybody asks about gold, because I know it's coming, basket of stocks, gold over the last 50 years, just look it up. I mean, it's not even comparable. Gold's a great, it's a great store of value. It's a great diversification piece, but you don't want to trade in all of your equities for gold for sure.
Yeah.
Doesn't create much cash flow.
It does not.
It doesn't create a dividend. I think the reason why it's done so well recently is just because of the fear of the printing, more money printing, more money printing, the dissolving of the dollar, et cetera. And so, but it's a diversified asset, right? And I think that's kind of the moral of the story is that you don't want all your eggs in one basket. That the first thing we ever learned about investing, it still holds true. Everything has its day in the sun, and we don't know whose day is next. It could be international, it could be emerging markets, it could be small cap, it could be mid cap. Who knows? And so by having a balanced portfolio, you're always going to have something that's doing okay.
No question.
Yeah. For the record, I think for about a year, I said value is going to outperform growth. I think it finally
You've done it.
I was with you.
Not wrong, just early.
Broken clock's right twice a day. I love it. Oh man. Well, and on that note too, that just with fear and the volatility in the markets. I mean, again, not a political thing. I think everyone can agree. Trump is not afraid to move in whatever direction he feels that he wants to move, and so the markets do like stability. And they like certainty that, hey, things are going to continue the way, or at least predictable. And, just the tariff thing has just been, wildly unpredictable. And maybe it's a negotiation tactic for him. Who knows? But you can see how much the markets enjoy it when, it's, wait a second, we're adding 50% tariffs. Oh, no, wait, we're taking them off. And that's part of the jumping around. Let's talk a little bit about the tariffs. I mean, I think probably at this point, everybody has a general idea of what tariffs are, but just how maybe why they're putting them in, or at least theories on why tariffs are coming in, and how that everybody understands now. I think that the tariffs are paid by the company and then typically passed on to the consumer. But what's the genesis behind that?
Thoughts?
Well, you hit it. I mean, that was the main talking point behind the last volatility we've seen in the markets here the last couple months, and a lot of it was the initial talk about implementing tariffs as a negotiation tool, but the markets didn't know what that level was going to be. Was it going to be 2%, 5%, 10%? And so I think that initial reaction to tariffs coming on caused the sell-off we saw in April. But then it was back in March, and then April got worse when they were released, and those numbers were bigger than they thought and more widespread. And I think that's what created a lot of that uncertainty and panic. But to your point, as far as tariffs go, yeah, it's paying a fee or a tax, if you will, to import goods into this country. And so the idea is to try to encourage the U.S. companies to build their product here in the U.S. And so
right. Whatever it is.
Yeah.
And you have two very distinct sides that, one, we have a massive trade imbalance because, we become a superpower because of it, that we've, taken our lower paying jobs and exported them to other countries. And then they've done the textile manufacturing and the mining and things that, don't pay very well, or, maybe we don't do well here. And then been able to, bring those back into the country and, have record corporate profits and GDP and again we're the wealthiest, one of the wealthiest countries in the world because of that. But there are other side effects to that, and so like I said, you get a massive trade imbalance where we're importing a ton but exporting very little, and so the whole tariff thing is, again, as I understand,
it's meant to protect your domestic companies, right? Your domestic producers. So if it's lumber and you're bringing lumber in from Canada, is there a big difference between their pine tree and our pine tree? No.
Commodity. Yeah.
If they can produce it cheaper, ship it down on a rail, and deliver it in the yard in LA, at 25% cheaper, you essentially put your lumber operations out of business. And for some people, that's okay. They don't want to cut anything here. We can import all that stuff from elsewhere, and it does economic and it does benefit, but it does environmental damage elsewhere. Is sort of the case study, and we're okay with that. And then somebody comes along and says, no, actually, we need to control our own natural resources or our own iPhone production or whatever the case of the day is. And that's really what the origin of tariffs is. It's meant to, protect your domestic companies. Does it work? But who knows? It's always looked as protectionism and other things. We just don't have the capacity to set up plants to do these things at the snap of a finger.
I think the other part of it too, aside from just protecting your U.S. based workers or companies, it's also national security.
Sure.
If you become reliant
Absolutely.
on all these other countries for every bit of your economy, whether it be pharmaceuticals, whether it be lumber, whether it be electronics, or they have their hands in all the electronics or the chips that come into the electronic devices,
for sure.
it becomes a national security issue too. So I think that's the other side of the coin, the reason for trying
Yeah. But I think most people look back and go, oh, well, this is really it's never been a really good thing to have in place for long periods of time. And, multiple times over this country's history, they've had to unwind these things in order to have some, favorable trade with other countries. And again, you're talking about somebody in the White House now that sees himself as a master negotiator. Mm. And sometimes the rock goes in the middle of the pond and it's big waves on the edge where people don't like it. And time will tell whether any of this stuff is even successful. And, I think we all sort of hope it is, but I mean, that's what the future's about. You don't know what's coming.
Right. And I mean, economics theory, right? All the economists say that, tariffs don't work. So that's, you got that side, but they've also been wrong on other things as well. It's just interesting. It's a debate that could rage on forever because while it is economically viable for the country to obviously produce goods and services cheaper elsewhere and bring them in, it's economically viable. And one of the things I want to point out is for who though. And so
for sure,
if it's viable for Apple, right, as a corporation or Google or whoever, Hewlett Packard, it doesn't matter. One of the things I just looked up, I think is interesting, is that while 67% of our 340 million population, or I guess I should say adult population, owns stocks in some form, right? Mostly through people's 401k or but 60% of our country does own them, either through mutual funds or whatever. That's the number of people that own any part of the market. The other side of that coin is 87% of the total value of the market is owned by the top 10% of wealth. Mm-hmm. And 50% of the total value is owned by the top 1% of wealth. So while moving production overseas and getting things cheaper and bringing it back, raises corporate profits, well, who owns the corporation? Well, the people who can own the shares, right? And the people that own the shares are people that own stock. And so it's a very interesting thing. And if you've ever seen the chart, excuse me, if you've ever seen a chart on, consumer price index, which is everybody knows has moved up, gas is more expensive, eggs is more expensive over, the last 50 years, real wages have been pretty stagnant. And so you have this widening gap between what people make in wages and what things cost. Obviously not things like technology, but just your basic commodities, goods, and services.
Well, and the way you can move those around is artificially, right? You can put in a giant, minimum wage, but all that really does is crush the bottom end also, because prices move up just as fast, maybe even faster than wages do. So if we're talking about, entry level positions, sort of the, jobs you had in high school or right out of school that are not meant to be career jobs. They're really not. And so the interesting thing right now, I think you're going to talk about a little more, is the middle class squeeze is when you have somebody who is managing people and they're making, I'm just picking some numbers here, $24 an hour. And then all of a sudden the brand new person that hires in, the 17-year-old that's still in high school, has to come in at $20 an hour. There's not that much of a margin, right? And so the years of experience and everything are sort of can and for some people's eyes can be meaningless if the next person in here that doesn't even know where the coffee machine is making $20 an hour. It doesn't really help that person, the $24 an hour person. And so, as a business owner, did they just turn around and say, "Oh, well, we'll just pay you $30 an hour," and then have to turn around and talk to the customer and say, "Hey, by the way, that burger that was $4 is now $7, but hey, I got to pay my people."
Yeah.
Like,
Well, if you've been to McDonald's,
they just go somewhere else.
You can see that.
No, they just add the gratuity percentage higher on the
That
kiosk.
can be done too. Yeah. So,
Yeah, fast food is not exactly a fast food anymore. It's just big, and it's all part of that.
well, it's not cheap.
It's not cheap.
It's not cheap. Yeah.
Yeah.
Minimum wage, and so now it costs you a lot more. But yeah, no, the middle class thing, I pulled up some things I thought were interesting just because I don't know if people realize that. And this is more by generation. But you go back to, greatest generation, silent generation, baby boomers. So, that's, 1901 through 1964. And it generally costs you about 3 times your income, 3.5, 4 times by baby boomers, your income to buy a home.
Mm-hmm.
That was you could basically have a single income family and you could afford to purchase a home. Back then, a lot of women stayed in the home and were homemakers. Fast forward to today, and again, these things just continue to move up. I said stagnant wage growth, but increasing prices. For our generation, I know we're all Generation X here. We were up to 5 times income by the time that we were in our peak earning years and being able to buy a house. So millennials, 6 times income. So now you're talking Generation Z, 1997, 2012, we're up to 80% of income. So it's massive numbers, and so when people start talking about, hey, we can't afford to buy a house, and again, there's other factors, and I'm not saying that everybody's working as hard as they could. It's again, we're purely zeroing in on numbers here. It's not the same as when baby boomers were trying to buy a house. 3 times income, 80% of income is quite a different, and it's something that I think we squeezed a lot of wealth, as we just pointed out, up into the to the upper class because of this outsourcing of jobs and corporate profits, and we own those, and that's been great. That part's been great, but a lot of wealth has been shifted up, and then you have a lot more social assistance. You have more social assistance programs, and so I argue if you're on social assistance, you really can't be middle class, right? Because middle would be you take care of yourself. Again, it's not a value judgment.
Sure.
It's an economic thing. If you can't take care of yourself, you need social assistance, you need government assistance. Well, then you're actually taking from somebody else. So you're not really middle class at that point. So we shrunk the middle class. We have more lower class. I guess lower class is not a great word, but people that need assistance, and then a small, same size, wealthy class, but way more wealth.
And it's easier now to move. The world's smaller.
Yes.
Like, you can move around really easily. And if you're wealthy and you live in Saudi Arabia, you can also live in Redondo Beach. Mm-hmm. And you're going to be competing with everybody else who wants to buy that beach house or wants to buy the house a block from the beach. And so I think I don't even know if anybody's even done any numbers on this, but ownership by non-U.S. citizens has to be off the charts relative to what it was in 1965. I mean, I don't think you had a lot of people that were here and had a second home or a third home or a fifth home in the United States, and now it's really easy. I was just in South Florida with my daughter 2 weeks ago, and you go down there in certain parts of the state, you speak Spanish. I mean, there's just massive influence from Venezuela, commonly Cubans in Miami. It's a great experience, but it's definitely a different place than when you just go to the west coast of Florida. And there's massive wealth that's pushed in there from Latin America, and the condominiums. That's who you're competing with. You want to live in Miami? You're competing with all of Latin America, probably much of Europe, to buy that same condo. And it's not, you're not just competing with the kids that you went to high school with to buy a house anymore.
Right.
And so, and again, I think there was a time where you had to bring a bag of money, and now you just wire money in.
Yeah.
It's very simple to do. And so Yeah, I don't know if all of this is the same in Des Moines or in Champaign, Illinois, or other places that are not coastal U.S. I don't think there's a big demand to get into the Tulsa housing market as there is to get into L.A.,
Sure.
Miami, New York City, and so yeah, I mean we're all raising kids right now and all staring down the barrel of where are our kids going to live? What are we going to do? I mean,
Tulsa.
if we just had a flight to Tulsa, it's a good place to start, right? Yeah. But yeah, there's going to be. I mean, most kids coming up now, if you want to just get in and buy a house, you're going to have some help from somebody else. There's just not a lot of.
Well, I mean, typically where we're
easy
seeing
upward
it
mobility
is, as you were going through these numbers, the baby boomers, the baby boomers and Gen X have benefited from the other side of this, right?
Yeah, absolutely.
And so what we're seeing is just those folks now, there's more of the parents are helping the kids from the equity in the home. It's just kind of passing the rock down the hill. Whereas a lot of the baby boomers and the silent generation, they did this on their own, but the houses were cheaper. So now that the houses are more expensive, they benefited. The equity in their home is tripled, quadrupled, quintupled, et cetera.
right?
So that's what we're
As long as you have ownership, and that's really what some of what Adam's talking about
I
too.
think,
Is
which was a lot
it's
more
not just,
common back then versus today.
It's not just stock assets. It's also real estate assets that are owned by a smaller group of people, and as we have plenty of land in the United States, like we have tons and tons of space relative to like Europe, let's say. But it's not uncommon for Europeans to never own anything as far as real estate goes. They're lifetime renters. Mm-hmm. For generations, it's been that way.
Yeah.
So I mean, as people become more city based, you're just going to have more of that.
I just think it's important to point out again, things change. Look in all things. I'm a big sports person. Things change. So when people who are baby boomers are saying, well, we did it, you should be able to do it. Well, it's different now. And it doesn't mean that you shouldn't work toward it. And but 3 times income and 8 times income are completely different numbers. It's just like, comparing sports accomplishments across, decades. I mean, comparing people in the 40s or 50s in baseball to today, it's a completely different game. I don't know how you compare it. If you've ever watched a 1970s NFL game, and then say, oh yeah, that's the same game I see on Sunday. It's not. Everything changes. So the tariff thing, again, this all goes back to tariffs, and we think what they're trying to get to. I don't know if it'll work. I don't know if it's the right answer. But we do have an issue with our middle class, and we have to have jobs for people to be able to sustain themselves without assistance, and not just push all the wealth up to the top. So,
and it can't just be artificial pay raises with minimum wage.
Correct. That doesn't do it.
Because it drives up prices too.
No, that doesn't do it.
Or more to automation.
Right.
And the folks that wanted the raise are out of a job.
Yeah. No, it's a big problem in our lifetime that's going to have to be solved. And I know I've heard tons of different ideas, but definitely raising the minimum wage is not the answer. We've already seen that. But also saying that, hey, this is great. We just keep making things really cheap, bring it over here. Corporations a lot of times have, offshore. They have offshore locations, and then they don't pay corporate tax. And again, we're financial advisors. We're working with people with money. We want it to be, we want the economy to work, and we want the market to work. But you do have to recognize that there are issues.
Yeah, and corporations, like they're just full of human beings.
Exactly,
that's all.
It's not a person.
And it's a competitive marketplace. And if one company is going to be able to bring in their jeans at half the price and undercut you, you're not going to sell jeans unless you pursue the same type of strategy.
Yeah.
So it's something that picked up, and when I was a kid, there was a big push to buy United States made products. Cars and everything else, and how much of it is actually made here versus assembled here. That's
has to be assembled, right?
Yeah, it's again. I think we'll talk a little bit about some of the rules that are changing right now, but it's a new rule set, and this is back to some of the market underperformance early in this year. When you change a bunch of the rules, nobody really knows how the game is played.
Yeah.
right? And so part of this, snap back after, we're going to put the tariffs in. We're going to put a moratorium on the tariffs. Part of that is, okay, we back to understanding the rules. As soon as some of this other goes back in, or we change a bunch of rules, it takes a while to digest it, figure out how to play the game properly, and best position yourself for success.
Yeah, I get the idea too that the market is a little different than it used to be. It's not as reactive. I had a feeling that the market is trying to drive policy, because if you're the market, right, you are the stocks, you are the corporations, you are the shares that people own. You don't want this. This is bad for profits, right? And things are going to cost more. You got to build them here. So right away, massive sell off, like try to affect policy and get it to turn back to the way you want. Listen, the market in the short run is very fickle, right? It's now. How can I help myself now? I think some of the things that we're trying to implement or at least thinking about are 10, 20-year things that, hey, how do we affect this for, our kids, the next generation?
Yeah. What was Buffett's quote on that? The short term, the market is a voting box. Long term, it's a weighing device. Yeah. So the proof has to be the profits. You have to be able to deliver good economic performance to be a viable company. So we're not all nonprofits.
Yeah. So where are we at on it? That was just a discussion on tariffs. It's a back and forth thing, right? They've been paused. They're in the courts now. So it's just a wait and see. But at the end of the day, we'll continue to follow it. But I don't think it's going to, it's going to affect the market in the long run extremely negatively.
Let's get into the tax bill. We've got a tax bill that went through the House, and now it's going to go to the Senate. But my guess, and that's I'll talk about a little bit. My guess, though, is it's going to get, I don't know, readjusted, affected,
reconciled,
chopped up. I don't think it's going to go through as is. Even from some of the Republicans that I've listened to, they don't like it as is. I've got a chart here. I called it the debt. Essentially, what this chart is going to show is the interest that we as Americans pay on our debt. And the interest has shot up dramatically since COVID for a couple different reasons. Not only has the debt grown dramatically, we're up to 36 trillion now. And I'm not sure what it was pre-COVID, but 20? I don't know. It's grown a lot. It's almost doubled in the last decade. But not just that, but also interest rates have gone up dramatically. And so when you have a larger debt balance and higher rates, then all of a sudden your interest expense, we're paying about 1.2 trillion every year just in interest expense. And so the term that some economists are using is they'll call it the debt death spiral, which is not a good sounding term. Mm-hmm. But essentially, if you don't get control of this, and this is what many of the senators are looking at, is that if the debt keeps growing, which that's the current trajectory, is that we're going to add more to the national debt this year and the year after that and the year after that. Some are projecting that in another 10 years that the debt will probably be somewhere around 60 trillion. And if the debt's at 60 trillion, and that's just assuming rates are where they're at, our interest expense keeps climbing and climbing and climbing to a point where we don't have the money anymore, unless we're dramatically cutting Social Security or Medicare or some of the other big programs. We just can't afford to pay the debt. And that's when you get into a spiral, because then you have to issue more money and borrow more money just to pay the interest, and the rates are going to go to the moon. And so what they're going to try to wrangle in this tax bill, I believe, is to cut more spending. That's what Trump ran on, was balancing the budget. And this bill in its current state is not doing that. And so I think that's where they're going to chop it up in the Senate. Now, where they're going to cut, I'm not sure. But that would be that's what I'm expecting. I don't know what you guys are reading about this, but.
Well, you got to compare campaign promises to, reality. Once you set it into the legislature and let them, like you said, chop it up. Because there were a couple things that were talked about widely. Let's see, no tax on overtime, no tax on tips, no tax on Social Security. And so unless you slash budgets all over the place, which looked like they were going to start doing, but has really tailed off. It's really, really difficult to make a lot of cuts. You have a big beast of a government that you spend a lot of money on.
Right.
It's very hard.
Well, most politicians don't run on re-election on how much money they didn't spend.
Yeah.
Normally,
Correct.
it's on look what I got for you.
Yeah,
Look
special interest is overused, but that's really what it comes down to. All these people are beholden to other interests. They all require money.
And every congressional district is its own special interest.
Correct.
Right? When we have somebody local here that goes to DC, what do they talk about? Well, we're gonna have more federal projects here. We're gonna bring money, and we need more of this. We need more of that. So that's really what. Forget about like private or lobbying special interest. We're talking about just you're supposed to be, representing your constituents, and your constituents want what their fair share or maybe even more. And so yeah, it's going to be. I think the next couple of weeks and get this thing figured out. It'll be all chopped up. But
it's like
there are certain things that
the
are
salt
likely
part.
to get through.
Everybody's talking about the SALT, the state and local taxes, and
Right.
whether or not you can use that to deduct against your income there. And the whole issue is, well, there's a number of states that don't have state and local taxes
That's right.
on that. So
That's right.
why are we paying for California, New York to charge all these
Additional
taxes?
subsidies.
Right, exactly.
Yeah.
So, I mean, again, there's your differences based on where you live too, not just what how you vote.
Well, and the tax package we have in right now is in place was put in 2017, right? So they call them the Trump tax cuts, and that got rid of almost all of your state and local tax deductions. So part of this new bill was, we're going to put this back in, and what I've read is the number is going to be somewhere around $30,000 for a married couple, phasing out at about $400, phasing down to a cap. Like a lower cap of 10,000, which is exactly where we are now.
Same.
So you are scooping up some people potentially, and adding that in, but for a lot of people it's a non-event because you're way under where you don't pay $30,000-$40,000 in state and local taxes to begin with, or you're over 500 in combined income, and you're right back to the $10,000 number. So
the bond market is expressing its fear. I think for too long, we as Americans, I mean, we don't want to face the music. No one wants to take a cut on any of their benefits. Mm-hmm. Just add it to the debt. We'll worry about it later. And we've been doing that. I think the last time we balanced a budget was Clinton. And so now,
Been a while.
since this already went through the House, we saw the 30-year U.S. Treasury spike. So that means you're loaning your money to the federal government for 30 years with the promise that they're going to pay you back in 30 years. Well, now people want to be paid a little bit more for that, even though it's technically guaranteed because the government will print more money. The fear that something might change 30 years from now, that's starting to.
I think you're getting a little bit of that, but 10 plus year Treasury bonds mostly price on inflation expectations.
Correct.
And so even though inflation seems to be down, there's thought that as things slow, maybe the Fed has to start lowering rates. We've been talking about that over the past few months too. And if they lower rates, you should have more economic activity, which should add some more to inflation, and potentially your inflation numbers go up quite a bit. I don't know. They're not chasing the inflation that we had a couple of years ago when we were in the 8s and 7s and 8s. I mean, I think people were really upset about that. But you do want economic growth. You do want GDP growth. And we were talking about earlier about GDP being down in the first quarter of this year.
Yeah.
You can't have too many quarters in a row where it goes down. I don't care what your academic definition of a recession is. If that's happening, people are down in income one way or another. You either lost your job, or you got your hours cut back, or your company closed down, whatever the case may be, and that's not going to be a good thing for anybody, really.
Yeah, I just looked at where inflation's like 2.3% year over year. So
Right.
Yeah, but your 10-year is reflecting that too. I think where this, to kind of put a bow on this bill, I think that's been reflective in there too, that if we're going to have to run a further deficit and likely print more money, then you're going to have some inflation.
Is your number somewhere around $2 trillion in added deficit,
Correct.
something like that, right?
Yeah.
Yeah. So that tacks on quite a bit.
Yeah. And I guess one thing that I always think about when we start talking about government spending, because it irritates me, that they work so different than us, right? We make money and then we spend it. Now you can spend money on a credit card, but that costs you a lot if you don't pay it off. Government spends the money and then goes and tries to find it. So they just spend whatever they want, and then if there's a deficit, then they sell bonds, and that's how it goes. So
Right.
it's completely the opposite of us. And how this relates, I've been talking to a lot of clients lately, and Roth's been a big thing. Roth. Roth is the best because I think it's all over the news. People talk about Roth. Dave Ramsey's talk about Roth all the time, and Roth is good. There's nothing wrong with Roth. It is good, but I always get concerned when you're talking 20 years from now, 30 years from now. Like the rules today, and we're talking about this spending bill and how different things are now than 10 years ago. The rules today are not going to be the rules in 20 years. They're just not. Doesn't mean that there's not going to be tax and there's not going to be some basic things that are similar. But if you think you're going to put all your money in Roth, and I could be wrong, but I'm going to throw this out. If you think you're going to put all your money in Roth and you're going to be very wealthy and you're going to pay no tax and you got another 20, 30 years, I would say you're completely off because there's going to be, they always need money. They're already analyzing our healthcare benefits.
Well, so part of this bill is no tax on Social Security, right? So that's already been essentially shelved. They're talking about an extra tax deduction for seniors, probably defined as 65 plus, of $4,000. You're going to get an extra tax deduction because you're 65 or older of $4,000, and that's supposed to offset some of the tax that you pay on Social Security. There was a time when Social Security was not taxed.
Correct.
And then 50% of it was taxed.
Correct.
And then for
85%.
most of our clients, 85% is now taxable. Yep. And so they throw. But to your point, yeah, as Roth gets bigger and bigger, $1 trillion, $2 trillion, $17 trillion, $30 trillion in Roth, and I've said this for years and years, you tell a Congress that that's untouchable. You can't touch the Roth, and they go, who owns all this Roth? Oh, the wealthy people. Well,
we can touch it.
Maybe we can touch it a little bit. We'll touch it here and we'll touch it there, and it's a slippery slope.
The only reason they don't touch Social Security and Medicare is because that's so universal.
But they do. But my point is, they do touch it. They do touch it, meaning they tax it now.
Oh, right. But that's a lot more under the carpet for most people. They don't see that as much as if they said they were going to cut their benefits.
But that's the touching. That's the touching that will happen with Roth.
Oh, no question. What I'm saying. Same thing.
My only counter to that too, though, is you look at, like you talked about, Social Security benefits and other things that have been changed, but it's also not like retroactive. It's changed for going forward.
The future.
So
that's right.
The future. So those with those Roth balances, the fact that they're going to go and undo that, I don't see it. Plus, they already have the inheritance part of the Roth.
No, not undo it. I think it'll be something more like if your income is over X, then maybe you get taxed 10% of the gains on your Roth. It'll be some little listen, all the taxes are nickel and dime taxes. They're never going to come in with.
Well, they start that way.
They start that way, right? It's always Obamacare tax, 3.8%. It's Social Security tax. It's disability tax, state disability taxes. They're all small. But my point on this, and this is arbitrary. We can argue it forever, but they're never going to go back 20 years and go, when you made that contribution, you deducted it. You can't deduct that. We're going to go ahead and get that back. But in the future, the rules are going to change. And if you have balances, again, we're not trying to freak people out about having Roth. I think it's a good thing. But I don't think that you should put all your eggs in that basket thinking, if I just get all my money in here, in 30 years, I'll never pay tax again. Like, that's probably not accurate.
Yeah. Today, you can get away with it.
Today, you could.
Today, if you're in distribution phase and you have all your money, you get millions of dollars in Roth, you're fortunate. You're going to be a good spot. But I think you're right. And as those targets just get bigger, it's easy picking, I think, for Congress 10 years from now to just go, yeah, we're going to have to go back and revisit this and just make it to where on distribution, when you start distributing money, if your taxable income is over $400,000, then your distributions are going to be taxed at 15% or whatever the number is.
It's not hard. You just have to follow the patterns. Like I said, healthcare, they're already collecting healthcare premiums. Not doing anything with it.
Information.
On it. Just information.
Yeah.
And then the people that, have, quote, Cadillac plans, according to their definition, probably someday, maybe soon, maybe later, will end up paying some tax on those plans. So again, I'm not saying that should. I don't like it, but it is what it is, and we're trying to help people now.
And the way you pay tax in that example, the way you pay taxes, it's just not deductible anymore.
Correct.
Because right now, companies deduct your premiums. Yeah, and they're 100% deductible. Whether it's $1,000 a month or $3,000 a month, it's 100%. Well, maybe for these plans, it's less deductible.
Less deductible.
Yeah, so
100%.
yeah, we'll see. You want to know a couple other things that are kind of interesting?
Yeah.
Car loans. They're talking about car loan interest being deductible.
I heard
going
that.
forward.
Wow.
For the next 5 years.
Thanks.
As long as you purchase between January 1st of 25
Phase out.
and phase out's at $200,000. $200,000. So and it's capped at 10 grand. Which is nowadays
Can't finance your Lamborghini and write it all off.
I don't
So you
think
can get
you'll be able
so you can
to.
get a fiat.
Well, I'm sorry, capped at $10,000 of interest per year.
Okay.
So that's a decent sized number.
Yeah.
But yeah, it's qualified passenger vehicles. So again, make a little definition for what's qualified and what's non-qualified, and again, does it have to be domestic? These are things that they may fold in there. Well, only on a U.S. car. If you buy an Isuzu or you buy a Subaru,
Honda,
you can't deduct it, or it has to be manufactured in the United States. Again, back to the
Assembled, manufactured.
Yeah, exactly.
That would change a few
Assembled.
conversations I've had just in the last 3 weeks. I don't know if you guys have, but I've had the calls where I'm purchasing a new vehicle. Should I pay cash or should I finance it?
Yep.
Or should I lease it? Going through those conversations because for at least 15 years, you always financed it because the rate was 0.
Yeah.
Or 1 or whatever.
So what are you
now,
seeing?
So now it really depends. It's a one-off case depending upon the client, right? Because if they're able to finance, typical rates right now are somewhere between 5 and 8, let's say.
Yep.
And if their money is invested in a quote balanced portfolio, that's kind of in the targeted range of what we're shooting for.
Yeah.
And so it really depends on their liquidity. It depends on their cash. It depends on everything, right?
What have your answers been these last couple of weeks, though?
Well, the last one, it was a gentleman that had inherited some money. Long story, really short, but his scenario was to pay cash because he was invested very conservatively, mostly in a bond style portfolio with a little bit of stock, and his finance rate was going to be $4.95. I'm like, it's a wash.
Correct.
It's a wash. So let's look at your liquidity. Do you mind carrying the payment? Would you rather not? Older gentleman didn't want to deal with it. I'm like, just write a check.
Yeah. I'll say the one thing, though, too, is that everybody thinks rates have gone up, right? Because we've seen that with the Fed, and you assume you hear the rates online or commercials for car rates, But a lot of these dealerships still, with good credit, if you keep your loan to 3 years or less, you're getting 0.9.
Yep.
On certain makes and models.
Right.
For sure.
So, I mean, like, for example, GMC, 0.9 for 3 years.
But
so
you got to be
in that
able to
case-
afford the payment. That's
Right.
the thing, yeah.
But if you're paying cash as your alternative, you could probably afford the
You
payment.
can afford the payment. Yeah.
So my point is, depending on the scenario, again, if your goal is to finance it for 6 years, 7 years, 8 years at 5%, that's I agree. It doesn't
not a
make
good
sense.
strategy.
But if you can still find the lower rates for a shorter period of time,
So
then it
summary
makes sense.
here too is ask us. I mean, these are the things we
For
these are
sure.
the things
Run
we
the
talk
scenario
about.
by.
Like, if you can find a 0% or 0.9 for 3 years and you can afford the payments, again, it doesn't deplete all your cash, you have it available. Why wouldn't you basically pay nothing? You're borrowing money for free. You either put it all in or you earn, let's just say you earn money market rates at the very lowest, right? You earn 4% and you pay 0.9. That's a 3% win.
well, and like we've said a lot lately, right? Shop your cash or shop your rates. I mean, a lot of people are running to ECU to get their auto loan because it's historically been cheaper than, say, the dealership. And now all of a sudden they're not giving you 0.9, but the dealership might. So
Well, because the dealership's got to move.
Got to move cars.
Got to move vehicles. They got to get them sold. So we had a client yesterday that bought at 0.9%. So she's financed for 3 years, 0.9%. Much better, much better. So she'll just pay out of her regular IRA distributions, kick them up a little bit, and she'll pay for the truck. So
Yep.
it's pretty good.
Always good conversations.
What else? To finish up this tips. So a lot of people, the article I was reading was cracking me up. It's like if you're in a service business that traditionally didn't get tips, you can't suddenly change all your revenue into tips. So like the rule is for occupations or jobs that had which customarily had tips prior to
No one ever
12/31.
reported them anyway. And so
Correct.
this is a nothing burger.
Well,
what I mean?
it's even worse than that because the case study was most of these people don't make enough money to pay a lot of tax in the first place. They're below the rate where they would otherwise pay tax. So again, campaign promise
it's not moving
doesn't
the
make
needle.
much of a
It
splash.
sounds good, but it doesn't have a real impact.
Yep.
You know what I mean,
Yeah.
because like you said, most people receiving tips aren't reporting it. It's
Right.
a cash tip, and
Yeah.
it's under
Well,
the radar.
and
I
even
mean, I
even
know
for
this
those
isn't
that
being
do.
recorded or anything, but I used to work at Applebee's. When I got tips.
Statute of limitation. I think you're all right here. You're old enough now, Jason, where that was a long time ago. But and then I guess the last thing I'll just say on this is if this bill goes through, it holds tax brackets steady through like 2028, 2029. So a lot of the conversations I've had with clients recently is like, okay, we got to wait till this bill goes through so we can actually see, because we can't really do a lot of planning on proposed bills. They have to be accepted and they have to be in place for us to change any of the plans or to have client situations really change.
Well, I think
materially.
a lot of it impacts estate decisions too.
For sure.
I was just going to say that.
Depending on where their estate's at, and the estate tax situation too is a lot of things that are up in the air right now.
For clients of higher net worth that have estate planning, different kinds of trusts and things like that, and if your estate warrants it, I would highly recommend, we look at this bill as it's passed and then see how that affects you, and speak to your attorney as well and your CPA, because there might be some changes that you need to do that could benefit you.
No question.
So Jason, you want to talk about so something that's been in the news, and especially as rates go up, Japan and the yen carry trade, and who actually owns the U.S. debt?
Yeah, let's stay on the debt topic just for a little bit. I mean, it's so massive; it is the elephant in the room. But I think one thing that is a misconception by most Americans is they assume that our debt, which is again is 36 trillion, is owned by the rest of the world. That they have us, they have us over a barrel, so to speak, because they have all of our debt and they could turn it in and things like that. But at the end of the day,
They can't turn it in. Let's be clear on that.
sell it,
They can't turn it in.
sell it, or drive rates up.
Nor can we refi them. It
point.
doesn't work.
But sell it off or dump it or whatever, where they're just driving rates up. But my point being is that at the end of the day, the majority of the owners of our debt is Americans. Over 20 trillion of the debt is owned by Americans through owning government bonds, pensions, things like that. But the majority of the foreign debt that is outstanding, most people assume that it's all China, because that's probably what they hear in the news and that's the headlines. But they're not the number one holder of our debt. The number one holder is actually Japan, at right around 1.1 trillion. China is only about 800 billion of the 36 trillion, so it's quite a small amount.
Again, 1 trillion out of 30-ish.
36.
So it was 1.3, but it's shrunk. A lot of that has to do with the movement in treasuries too. But it's around what was that number I just saw? It was around 765
For China.
billion. Correct, for China.
Yeah.
So which is only 2% of the debt. It's not like
It's not as big as people
large.
believe, I think. And so the one thing that's making the news, you may hear it on occasion, it's called the yen carry trade. And what that means in English is that for decades, Japanese bonds were trading very, very close to zero. So you could borrow money in yen, borrow it from Japan, and maybe you're only paying about 0.25%. And you immediately take that money, convert it into dollars, and then go do U.S. bonds, and you're going to make it a spread on the difference. And traders and hedge funds and investors would pull this off, I think, for the last 10 to 15 years maybe. But what's happening here recently is we're seeing, well, let me back up. That trade works if one of two things, or I think both things need to happen. The rates need to stay where they're at, where the Japanese bonds are, it's cheaper to borrow and you're investing for higher. So we get that. But it's also a currency risk, because if you need the dollar to stay strong and the yen to stay weak, because otherwise you got to turn the money back in and it could go against you. So the chart that I've got up right now, it's the two things that matter most to this right now. You've got, on the orange line, you've got the Japanese 30-year government bond interest rate, and that's going up and to the right. And then you also have the strength of the yen versus the dollar. You could say it's flat. You could say it's kind of going up and to the right, but it's not going down. And so with some of the items that we've mentioned with what's going on in the U.S., whether it's tariffs, or this tax bill or debt or printing money, our dollar has weakened a little bit to the yen. And so this carry trade that we've heard about may no longer work. How that may affect our bonds.
And their interest
we'll
rates
see.
gone up, relatively speaking, a lot.
Right. So,
Yeah.
so the spread on what you would make between the two bonds, right now, the Japanese 30-year bond is at 3%. Our 30-year bond is about 5%. And so our traders really going to take that much risk in the currency exchange in order to make just, 1%, maybe 2%.
Yep.
So it's somewhat news relative. But at the end of the day, even if this didn't carry on anymore and people weren't, buying U.S. bonds for this trade, the Japanese bonds as an exposure to our total debt is still a very small amount, 1 trillion of the 36. So again, it's in the news, but I wouldn't be too concerned about it.
Yeah, I think the real risk is that the news part of it is that Japan's going to unwind. This yen carry trade is going to unwind. In other words, people are going to get out of all their
Flood the market.
non-US non-yen bonds assets, and they have to pay back, in yen. But like we just pointed out, it's 2% of the
Well, and
Treasury
it makes a ton of
debt, sorry.
it makes for a lot of volatility when that unwind starts to
Yes,
happen.
correct.
Because it's not just one entity; it's massive leveraged, hedge funds and global macro funds that do this all at the same time.
Yep.
Because it turns negative for them all at the exact same time, and so
Correct.
they all have to rush to the market to unwind the whole thing. And we saw that. I think it was in the fall. I can't remember exactly what month it was, but it was pretty nasty for global assets for about a week, and then it got settled down.
was.
Reminds me years ago. There's a huge sell off, and we didn't find out for like 2 months after that Saudi Arabia went in and raised like $40 billion and sold out equities because they just needed some cash.
Yeah.
And it's
Everybody's trying to figure it out.
Where's all the selling coming from? And then you find out, it's one player that has just massive amount of assets in play. So
Right.
anyway,
What about housing?
did we cover housing? I feel like we covered housing.
Yeah, I mean, housing. So mortgage rates are still about 7%. Home sales are up a little bit. I think we've had 2 rate cuts, right? We had 3.75.
Correct. 2 rate cuts, but it just hasn't affected folks with their mortgages yet because the mortgages are pegged to the 10-year.
10-year,
which has really been idle after it did the run-up. And so what we're still seeing is just the sales are low because you've got all these folks. Most of the country has a locked-in rate that has a 2-handle or a 3-handle. And you got to have some really strong motivation to sell your home and move it into a different home, knowing that not only is the house going to be more expensive. I mean, you might be trading dollars if you sell yours, but usually people are moving sometimes to downsize, but oftentimes to upsize. You have more children, need more rooms, et cetera, or you relocate. But when you're going from a 3% mortgage to a 7% mortgage, in most cases, your payment's going to double. And so what people are doing is
At
they're
least.
At least, yeah.
People are just sitting
maybe
still.
triple, huh? Triple.
No comment.
So they're not moving. They're sitting still. Maybe they're doing more remodeling. They're adding that room on. They're doing things like that. But that's what I'm seeing a lot of in the housing market is just overall transactions. There's just not a lot of.
And for a couple of years, we
going
keep thinking that rates are going to go down, mortgage rates are going to go down. And I do have a chart, and we don't have to show it, but I put the 30-year up there. We're about where we were in October-ish of 22. It's been range bound, really in the high 60s,
Ever
and
since rates went up.
hasn't really moved.
Well, and I've got clients asking me that too on occasion. Like, when do you think we'll be back to 3%? And I said, if we are, I don't want to see what's going on in the economy to cause that because
That's right.
the rates weren't down at 3% for mortgages naturally. They were down artificially. The government pushed them down because we were coming out of the great financial crisis of 2008. And so as to kind of, kickstart the economy. We've seen rates at low coming out of COVID. So rates don't just want to go down there naturally on their own because the market's healthy.
No, it's a weak economy because if you can just artificially push rates down, but then you get inflation, which pushes all of your rates right back
Hence
up on
where we are
on
with
the
all
long
the real estate prices.
That's
now,
right.
Right. So if you speak to people that are over the age of 60, 7% is not an abnormal rate. It's just what we're dealing with right now. The difference of it is just the price of the home is so different. Mm-hmm. Yep. And so that's where I've gone back to with some clients is who mentioned Europe. where renting. I mean, we've all grown up with this story and this adage that buying a home is the American dream.
Yeah.
You might have to fact check me on this, but I could have sworn I read somewhere that term was actually coined by J.P. Morgan in the 20s because they were trying to figure out ways to finance and they couldn't make enough money on Model Ts. So like, how do we make more money? Well, we've got to do home loans. Everyone's renting or they live on the farm. We got to sell them homes. Well, how do we sell them homes? Well, heck, it's the American dream.
Started an industry.
If you don't own a home, then you're not being an American.
Yep. Borrow money to buy a house.
So I've told a lot of retirees, if all of your money and a lot of your money is wrapped up in that house, renting ain't so bad, and you've got someone else taking care of the property. You don't have to worry about it. It's a consideration at least. And
you don't have to replace the roof.
Yeah.
You don't have to. You don't have to pay attention to a lot of things. And reality is, a lot of our clients' net worth is wrapped up in their house, and it's hard to just peel off a little piece and spend it on a vacation.
Well, I joke about that too. It's like you have to go to the hospital. You can't bring them sheetrock.
Yes.
And the hardest time to borrow money is when you need it.
That's right.
Right. And so that's a conversation part of the financial planning is that if someone has 80% of their net worth in the house, it's a consideration to maybe become a renter.
Yep.
It's not we've been raised so long that is such an awful decision, but really it shouldn't be looked at that way.
But part of that factor too is in the financial planning is also looking at the appreciation in the home, right? So if they, like we talked about generations before, have been in the same home for 40, 50 years, they may have spent, $100,000 on a home that's worth $600-700. Yep. Getting out of it just so you can go, do something else doesn't make a lot of sense either. So that's where conversations with potentially home equity lines or other things, if you are truly illiquid with most of your assets tied up in a house with a huge unrealized gain in it, then there's other options you can look at too for that.
This is super similar to the car loan thing.
Yeah.
It is a question.
Right.
I would say, honestly,
it's dependent on the person.
Top 5 question we get in doing this for as many years as we've done it. Top 5 question: should I pay off my house?
Yep.
And questions around the house. Paying it off, getting money out, renting, buying. So it's an individual thing, but that's definitely something that.
Answer is it depends.
It depends, yeah. And even for young, one person we didn't talk about was people who don't own yet. I know it's more expensive, right? And rates are more expensive, but if you can afford it, you can refinance. So rates probably will change over the course of, if you're in your 40s, 30s, 40s, and you have a lot of years left, rates probably will change. So if you can afford it and you want to buy a house, it doesn't mean you're locked into 7% forever.
The problem is they're front loaded with the interest payments, right?
Yeah, that's right. 100%.
So if you got 7% for 4 years, and you're like, now I got 3 repay or refi, then all of a sudden you just wasted 3-4 years worth of payments essentially.
Yep.
Towards interest.
Yeah, you typically have to be in it a certain amount of years for the refi to make sense.
And again, this goes to the depends thing. Every housing market is different too. You're if you're living up in the Bay Area, you got a completely different thing than if you're living in Bakersfield.
Tulsa.
It's just different. Tulsa.
Right, well, we typically try to talk about things that are a little bit interesting. So kind of close with, we've hit quite a few things, but you want to talk a little bit about our good friend Warren Buffett, who's finally retired?
Yeah, at the young age of 94. What is he? Is that right?
90-something.
He's still sharp.
Imagine if that guy said, I'm 65, I'm out. Like, talk about somebody who's so productive past what most people think about as the retirement years.
Yeah.
And always super busy. It wasn't like he was doing this from the beach,
No.
So.
No, it's been, working in this industry, it's been fun to watch and learn about. Everyone, you can just use his first name and people will know who you're talking about when you're describing a strategy or an investment or someone said this or someone said that. And so, what I put together was a couple fun facts on things that are Warren related. We'll forever use quotes and things that he has said. Like I almost brought up one when you mentioned earlier when we were talking about performance, the Warren Buffett rule. Rule number 1, don't lose money.
Yep.
Rule number 2, see rule number 1. And so, these are things we're just not going to forget. But couple fun facts about Warren. So he's beaten the market for over half a century. And so since taking over Berkshire Hathaway in 1965, he has delivered an annualized rate of return of 20%, which is nearly double the S&P 500 over that same period of time. So had someone invested $1,000 with him on day one, that $1,000 today would be worth 30 million, which is
$1,000 in 1965.
not today. It's 30 million. So
30 million.
Yeah.
That's bananas. Then the quirks, right? The quirks is things about like his diet and where he lives and things like that, which are pretty funny because he doesn't live like someone you would expect
Lavishly.
worth $100 billion. So he's known for his frugal and childlike taste. He drinks 5 cans of Coke,
Childlike.
5 cans of soda a day.
He's a
And
cherry Coke guy, right?
He
I think
doesn't
he's
drink
cherry Coke.
diet,
Yeah.
and he's
Yeah,
94. He eats McDonald's breakfast, and he says, if I eat 2,700 calories a day, a quarter of them are from Coca-Cola.
Best spokesman.
Yeah, he was the largest shareholder in Coca-Cola, institutional shareholder in Coca-Cola for a very long time. I don't think he is anymore, but yeah,
Let's see what else.
So much cash now, so
lots of cash.
He still lives in the exact same house that he bought in 1958. He bought his Omaha home for $31,500. Probably still worth $31,500.
I doubt that.
it's not Tulsa.
But still lives in the same home.
If we had any Tulsa clients, we're getting fired. We know that, right?
Yeah, we're out. We're out. How about the Tulsa people going, you guys know you're in Fresno, right?
Yeah, exactly.
But again, worth over $100 billion and still lives in the same home for the last 70 years. Now, here's something I think is I mean, it's impactful for what we do. It's very difficult for people to think about compound growth of their money. We think linear instead of exponential. And when we keep telling folks, that old saying about it's not timing the market, it's the time in the market, Warren's the perfect example of that. We think about how wealthy he is today. What's my notes here? By the time when he was 56, which, we think of many of our clients around 56, they think they're eyeing retirement down the window or down the hallway, so to speak. At 56, he was worth just $1 billion. And so 99% of his net
Say
worth.
just. Okay.
Well, compared
Just
to
want to make sure I heard that.
Rounding error now.
compared to what he's worth today, right? And
Yeah.
so 99% of his wealth occurred after age 50. And so what's another fun fact? Did you know that Warren played the ukulele? I didn't know that. No. So I guess he plays it at the shareholder meetings.
Yeah.
Warren Buffett, I mean, he's 94, so he'll, hopefully lives as long as he can. But obviously, he's probably in the twilight years of his life. But I'll always remember him for the gold thing in August of 11, when he started. Everyone was buying gold, and he started getting peppered with the gold questions. And he had a great. You probably look it up; it's still online. It was great.
It was a CNBC interview.
Yeah, great rant about why would I buy gold. It reminded me of Matt Damon in Good Will Hunting. Why shouldn't I work for the NSA? Well, should I buy gold? Well, let me give you a couple of reasons. And just goes through this whole thing about how if I had all the gold, and he knew exactly how much it would be some giant cube, 66-foot cube or something. And he's like, and then it would just sit there. And I'd just pet it and say, looks like gold. Nice.
And then ask it to do something for me.
Ask it to do something, but it wouldn't because it's gold and it won't do anything. And then he compared it to all the things he could own for that same, at the current price of gold and all the gold in the world, which would make this cube. And it was, I can't remember how many Exxon Mobils and all the farmland in the United States.
It was all the farmland in the United States, 7 Exxon Mobils, and a couple trillion in walking around cash is what he said.
And honestly, if you went back to 11 and you mapped out what he said to do, if you just had the Exxon Mobils and all the farmland and the walking around cash at cash rates, or you had the gold, you'd be way ahead with what he wanted to do.
And that doesn't even factor in the dividends and interest from ExxonMobil.
Well, correct.
That's right.
That's the thing with gold. He said it doesn't do anything. It just sits there. And
He also avoided Bitcoin.
yes, and right. And by the way, that CNBC interview was right at the top of the
It doesn't do
gold.
anything.
Yeah.
Right at the top of the gold market. Now, again, gold was back up higher than then, but it took, what are we at? 14 years.
Well, I've watched. I mean, I'll bring a chart for next time. I've watched the cyclical nature of it, and I think it can add as a complement because for that same decade,
It can, for sure.
For that same decade where gold was flat from 11 to 21, the S&P 500 was flat from 2000 to 2010.
Yep.
But we still make a case that we should own stocks.
Yeah. No, I'm saying gold is a good piece of a portfolio, but typically the questions we get are, should I sell everything and buy gold? And typically.
That's a different conversation. The
Well, when they see
world's
it up,
ending.
right? It's really high right now.
Yeah.
It's like, hey, this is time to buy it.
Because the grocery store takes gold, right?
They do not.
You just shave it off.
Shave it off. Okay.
Yeah. But they don't take stocks either.
Get a gold shaver. They do take Bitcoin sometimes.
Yes, they do.
Sometimes.
Well, our last we'll do a little bit of this is digging way back into the past. But our last roundtable and predictions, which again we're supposed to be for the rest of 24, but now we're into half of 25. So Jason said more volatility, VIX to 25. I'm gonna give him a win on that because I think he got to 82 at one point. But for a little bit longer period. Kyle said rates down from 665 from 779s and value up. So the value up finally.
Hey,
Rates down, meaning mortgage rates.
Mortgage rates. And mortgage rates are down. We're just not down maybe as much
they're
as we
more
thought.
that 7 versus that 8 range. So
Yeah,
I
Chris
get
said
partial right.
Chris said tech M&A increased. Where are we at?
Non-researchable.
Yeah, none of Way to go, Chris. And then I said I was still staying with the 2024 rate cuts. No rate cuts, and then cuts did begin, I believe, late 2024. So if we got any new, it's been a while, but we're halfway through rest of the year. What do we think it's going to look like?
I didn't have it written down, but speaking of rate cuts, the jury is out really on what's going to happen this year. And now if we get this with the tariffs, depending on what's really going to happen there, I guess we'll see. But Jerome Powell has a very good case not to cut, and I could see him making a case where.
Well, they're still arguing too.
They still are.
So they're still saying that. And in his response, apparently, that he gave Trump on Thursday was that, the market is going to dictate this, not politics.
Right.
And so,
well, they're divided as a Federal Reserve Board.
Right.
Forget about Trump, interjecting any of it. They're not unanimous as a board. So and some of that again is regional too. And these boards, the governors of the board are from all over the place. So.
But I think it goes back to, if I recall, when we were talking about rate cuts last time, and it was no cuts for 2024, but it was kind of that I still think it's potentially 2 cuts total, and that's kind of what we've seen. And if things hold true, it's, from our last conversation to the end of 25, if it holds true, it was 2 cuts. Now, I know they're still forecasting another 2, but it's definitely not. They're not coming down like everybody was talking. You remember back in the middle of last year, it was 6 cuts.
Yeah, no.
It was, almost 2 full percentage points we were going to drop.
And I think that's something that we kind of talked about too, is that we spent so much time in that 0% interest rate environment that you start thinking that's normal. That's not a normal interest rate environment. And so, and it's actually better, we've talked about this before, that we do have some interest. Again, you should get paid for saving money, for putting money away, and it should cost you something to borrow, right? And you should. And the other thing is, if we do have economic slowdown and hiccups, then you have the ability to cut rates. If you're already at 0, what are you gonna do? Negative? No negative
tools.
rates.
No tools.
So
even though we've been here for a while, I was just talking to someone yesterday that still has cash way too much in a checking account, not knowing that they could be earning more on that. And so I would urge everyone, either talk to us, shop your cash. You don't have to take on risk to earn more than 0. The rates are up there. They've been up there.
Well, 90-day T-bills are still 4.30, 4.35. So,
Right.
That's a pretty good number. And we won't quote any like mortgage or money market rates, but you should be getting north of 4 on what you're saving. So, for your emergency cash or if you're just talking apples to apples, there's no reason to keep money at the bank at 0.25% a year. It's
right.
You're costing yourself a lot of money.
They're not lending it out for that.
No, I don't think so.
no. Yeah, no, it's a more, like I said, it's a more normal, and it's what we talked about before. It's all tied together. That hey, that's why mortgage rates are higher. That's why car loan rates are higher, because rates are higher. So it all works together. But this is so I'll give you my prediction is I think rates hold. I really think that I'll stay with rates, and I don't think that we
talk about Fed fund rates,
and I think we'll be in a similar interest rate environment even on the 10-year. I don't see a lot of movement because there's not a lot to move it at. Short moves, day to day, week to week, but economy looks pretty healthy so far.
If we're just looking out 90 days, I'm just kind of sensing range bound with a lot of things, whether it's the interest rates or U.S. stocks. It just seems like there's, and we always say this, but there's a lot of irons in the fire when it comes to the tariffs, when it comes to the tax bill. Just and what historically what markets will do is just kind of sit on their hands until information is more known, right? Because the one thing markets hate more than anything else is uncertainty, and that's what we saw in April, the uncertainty around the tariffs. And so if there's more uncertainty now around a tax bill and things like that, I could see the market being more range bound until we have information. If the bill doesn't pass, if it does pass, things like that, I think in the short term, it would move the market. Again, these are 90-day predictions for our clients. This is irrelevant, but it's just kind of fun for us.
I was going to stick in the same spot. I mean, yes, whether or not I still think value is going to outperform growth or not, but I do think we're going to be in this range that markets are going to be very reactionary to news both directions. And so I think we've kind of set in our floor. Now we're going to set in our ceiling. And until we get more certainty on the tariffs, the tax bill, all that works out, I think that will determine which direction the markets can move further. And it'll just kind of stay in this trading pattern in between then. And we didn't even talk about it because it just got released or announced this morning here, but essentially one of the upper court, federal courts just, said that Trump's tariffs were not okay anymore. And so, now he's going to appeal that. And so, again, there's still this uncertainty and change to what we talked about of what markets know and what markets are aware of, and that information is constantly evolving and changing. And until there's, more clarity on the big picture stuff, right? There's always going to be uncertainty and things we don't know about. But until we know, okay, well, is this tax bill going to get through and what does it look like? And how long are these tariffs going to be in place and what are they going to be at and what the end game is? I think it's going to be kind of just in this trading range.
To go back to the very first slide, bring this full circle. I think that makes sense why having international, having diversified, maybe having some bonds in there, age appropriate, goal appropriate, et cetera. But that's kind of my prediction too, that if U.S. stocks are range bound, if interest rates are sideways range bound, then fixed income should do okay. If that's the case.
It's been a number of years we talked about before because of what interest rates did. But if we can collect that mid single digit 5, 6, 7% in our fixed income,
helps the balanced portfolio.
It's okay to be in it.
Right.
Age appropriate.
Chris?
The only thing I put in there really is I think I wrote down corporate arms race. There's so much investment going into artificial intelligence and robotics, and that part of the market is actually down for the year, probably more so than a lot of other places. And I'm not saying that the stock prices have to go up, but there's just going to be so much more corporate investment into that space that those companies that are tightly aligned with AI and stuff are have to benefit over time.
What's your prediction on a certain company and their taxi fleet taking off in Texas over the next month?
I have no idea.
Name left unmentioned.
Some of my favorite
relocate to Tulsa.
some of my favorite videos to watch are the cars trying to park themselves in a parking lot. So
the self-induced traffic jam.
Yes.
Well, company aside, because there's more than one doing it, it's going to be interesting over the next years to come.
For sure,
because that's definitely a trend. On seeing more and more, it's going to be less awkward when you see a vehicle without a driver.
No, people have to do it 1 or 2 times, and they'll immediately be comfortable with it again. I mean, you could have a bad experience. Don't get me wrong, but I think just like any piece of technology, I mean, wasn't very long ago people didn't want to touch a phone with their fingers, and move stuff around on the screen, and now everybody's got them. It doesn't matter age, it doesn't matter gender, it doesn't matter any of it. You most people have a smartphone now, and the things that everybody was afraid of, it goes away really quickly because figure out how convenient it is.
Well, people used to be scared of the internet.
That's right. Yeah.
Now, we don't do anything without it.
Correct.
Yeah.
The same people that told you I don't know about that, or the same people that call up and say, I just checked my balance, and did you buy some more of that thing? And you're like, yeah,
Online.
I did. Yeah, I got it done. So.
Well, good. I think we'll wrap it up. Appreciate everybody listening. Hopefully it gets you to think and generate questions. As we always say, we appreciate talking to you, talking to our clients, and just some of these things don't have a right answer, right? I mean, we talked about tariffs and how that works and how it may or may not, work out in its intended effect. But that's what we're here to do. I mean, we follow this every day and love to talk about these things and love to answer your questions and love to help you with, finances and planning and all the stuff that goes into it. You can contact us on Facebook, LinkedIn, YouTube, our website, strongvalley.com, which has a ton of information, ton of resources. And then, like I just mentioned, always reach out, share with friends. If you have anybody that has been asking some of these questions or you think you'd find this valuable, please send it along. And we'll try to do it a little bit sooner than last time and pick it up.
Should be end of the summer, right?
Yeah, end of the summer. Should pick it up here again in August, I think.
Yeah, that'll be good. We'll have.
And send in questions because, we're meeting with clients all the time and we're hearing things. But if you guys are around the water cooler or around with your friends and things are getting brought up consistently, it's usually, not just you guys talking about it. It's good topics for us to address here.
Yeah, 100%.
Question.
We'll wrap it up there. Thanks, everybody. And we'll see you next time.